I mean, if you think back to 2008, millions of investors just watched their portfolios completely evaporate.
Oh, absolutely. It was brutal.
Right. But for a lot of them, the most painful part wasn't even the broader market crash. It was like the realization that the specific companies they poured their life savings into weren't just victims of a bad economy.
Right. They were already rotting from the inside out, like long before the crash ever happened.
Exactly. Just imagine doing all this hard work, right? You research the global trends, you pick this booming industry, and then you just blindly hand your money over to a management team that's quietly steering the ship straight into an iceberg.
It is, well, it's the ultimate nightmare scenario for any investor because getting the macroeconomic stuff right, understanding demographic shifts or global supply chains.
And that's only half the battle.
Exactly. It's really only half. If you pick a company that is fundamentally flawed from the inside, all of that brilliant high-level forecasting just won't save your capital.
So today, we are learning how to look past the glossy PR and actually find that internal rot before it bankrupts you. For this deep dive, we've got a stack of high-level financial analysis sources, specifically zooming in on the NISM Research Analyst Workbook, Chapter 7 to be exact.
Yeah, the section on business and governance, it's dense, but so valuable.
We are zooming all the way in, moving from the macro view of the economy down to the micro. Our mission today is to, extract the definitive framework for tearing down a company's business model, judging the true motives of the people running it, and spotting those hidden risks that are lurking just out of sight.
Which is such a vital transition to make because when you analyze a broader industry, you're mostly looking at external forces, right?
Yeah.
Things like consumer demand, government policy.
Things outside the company's control.
Right. But when you put a single company under the microscope, the game changes entirely. Now you're analyzing internal decisions, human behavior, and, well, the structural guardrails meant to keep greed in check.
Okay, so let's unpack this. Because the research establishes this absolute, non-negotiable first rule of company analysis. And it's deceptively simple. It's just, do I understand the business?
Yeah, the foundational question.
It kind of reminds me of someone buying this wildly complex piece of industrial machinery without ever glancing at the manual. Like, if you don't know what the machine actually does, how can you possibly know if a gear is broken?
You can't. You really can't.
But, I mean, is it really a strict rule? Should we actually just walk away from companies whose business models are just too complex for us to grasp quickly?
Oh, without a doubt. I mean, to drive this point home, financial analysts often point to a famous piece of wisdom from Warren Buffett. He basically said, wide diversification is only required when investors do not understand what they are doing.
Wait, so if you know what you're doing, you don't need to diversify as much.
Exactly. The logic is that if you truly understand the granular mechanics of how, a handful of companies generate cash, you don't need to spread your bets across hundreds of mysterious, convoluted corporations just to feel safe.
You just focus intensely on the ones where you know exactly how the engine works.
Right.
But I'd imagine how the engine works looks, well, completely different depending on the sector.
It does. Yeah, which is why you have to use the right measuring stick. If you're analyzing a retail chain, you aren't going to look at the same data points you'd use for a commercial bank. For a retail business, the lifeblood metric is same-store sales. Sometimes they call it comparable store sales.
Okay, so measuring the stores they already have.
Exactly. You need to know if the existing locations are actually growing their foot traffic and revenue year over year.
Rather than a company artificially inflating their total revenue numbers just by, I don't know, taking on debt to open 100 new stores.
That is exactly the risk. You want to see organic growth, not just aggressive expansion masking a dying core brand. But on the other hand, if you're analyzing a bank,
foot traffic doesn't matter.
Right, physical foot traffic is almost irrelevant. For a bank, you care deeply about the net interest margin. That's the spread between the interest the bank pays out to everyday depositors and the interest they earn by lending that money out to borrowers.
Okay, so if you apply the retail metric to the bank or the bank metric to the retailer, your analysis is just totally worthless.
Completely worthless. You have to speak the specific language of the sector.
Got it. But beyond those niche metrics, there's this universal concept in our source material today that seems to separate decent businesses from the truly great ones. Pricing power.
Ah, yeah. What's fascinating here is that pricing power is widely misunderstood. People often assume it just means a company has a monopoly and can, gouge its customers to hit record profits.
Right, like raising prices just because they can.
Exactly. But in reality, pricing power is fundamentally a defensive shield. It is a company's ultimate protection against inflation.
A defensive shield. That's interesting. I usually think of raising prices as this aggressive move. How does charging more act as a shield?
Well, think about the mechanics of inflation. Let's say you manufacture a physical product, and suddenly, global events cause the cost of your raw materials, your energy, and shipping to just skyrocket.
Which happens all the time.
Right. Now, if your product is highly commoditized, meaning it's practically identical to a dozen other cheap alternatives on the shelf, you are trapped. The moment you raise your price to cover those new shipping costs, your customers will instantly abandon you for a cheaper rival.
So you basically just have to eat those higher costs.
You eat the costs, and your profit margins collapse entirely. But consider a company with strong pricing power. Maybe their brand is deeply trusted, or maybe their software is so deeply embedded in a client's daily workflow that switching to a rival would take months of painful retraining.
Oh, so they're locked in.
Yeah. So when inflation hits this company, they simply raise their prices, they pass the pain of those escalating input costs directly onto the customer, and their profit margins stay perfectly intact.
Allowing them to survive the inflationary storm while their weaker, commoditized competitors are just bleeding cash. That is an unbelievable advantage.
It really is.
But I mean, having a brilliant product that commands pricing power creates a new problem, right? Success breeds imitation. The moment you prove a market is highly profitable, competitors are going to swarm in. So how does a company actually maintain that edge over time?
Well, our sources break competitive differentiation down into three core pillars. To outperform your peers over the long haul, you have to dominate on at least one of these fronts. So the first is product features.
Meaning you just have the shiniest gadget or the highest quality material? I mean, is that really enough to build a permanent moat?
Not on its own, no.
Yeah.
Because today's breakthrough feature is tomorrow's industry standard. Winning on product features requires a relentless, heavily funded commitment to research and development.
So they can't just rest on their laurel.
Exactly. It has to be a culture of continuous innovation. You cannot coast on one brilliant invention. Otherwise, your rivals will simply reverse engineer your success and sell it cheaper.
Which brings us to the second pillar, competitive pricing. Now, I'm assuming this isn't just about randomly slashing your prices to win a temporary turf war.
Far from it. A true competitive pricing advantage is driven by operational efficiency and economies of scale. It's about fundamentally restructuring your supply chain so your baseline costs are lower than anyone else's.
Oh, so it's structural.
Right. If your internal operations are incredibly lean, you can offer a lower price to the consumer and still walk away with a healthy profit. If a bloated competitor tries to match that low price, they will literally bankrupt themselves.
Wow. Okay, and what about the third pillar, better execution?
Execution is all about logistics, distribution networks, and turnaround times. You might sell the exact same product at the exact same price as a competitor. But if your internal software allows you to deliver that product to the customer's loading dock in 24 hours instead of 5 days,
You win the contract.
exactly, your execution is your edge.
This feels like a good time to bring up a framework the Switch material spends a lot of time on. The SWOT analysis. Strengths, weaknesses, opportunities, and threats.
Oh, yes, a classic.
Now, I have to push back a little here. SWOT feels like, peak corporate jargon. We all know strengths and weaknesses are internal to the company, while opportunities and threats are external forces.
Right.
But if weaknesses are internal, no CEO is going to willingly put their fatal flaws in a press release. How does an outside analyst, like someone sitting at home with a laptop, actually uncover the weaknesses a company is actively trying to hide?
That is the exact trap that amateur analysts fall into.
Dave?
They approach SWOT like a corporate marketing exercise, just waiting for management to hand them a neat list of flaws.
Which they'll never do.
Right. The best financial minds actually approach the framework in reverse. They completely ignore the company at first and focus exclusively on mapping out the external threats.
Oh, interesting. Walk me through a specific scenario of doing this in reverse.
Okay, let's say you identify a massive external threat looming over an entire sector. For example, a sudden technological shift that will require companies to completely overhaul their software infrastructure.
Like the transition to cloud computing or something.
Exactly. That threat is visible to everyone. So once you identify it, you work backward. You turn your attention to the specific company and ask, does this management team have any history of successfully executing a major tech migration?
Ah, I see where this is going. And if you look at their executive roster and see they haven't hired a new IT director in a decade.
Then you have just uncovered a glaring internal weakness. You didn't ask the company to confess their lack of adaptability. You identified the external pressure and then dug into their structure to see if they were uniquely vulnerable to it.
The lack of modern experience becomes a fatal internal weakness the moment an external shift demands rapid adaptation.
Precisely.
So what does this all mean? It means you have to stress test the organization against the harsh reality of the world, not against their own optimistic projections.
Yes, exactly.
But even if a company passes that stress test, even if they have pricing power, lean operations, and a solid balance sheet, isn't there an unpredictable variable that numbers simply cannot account for? Like, what happens if the people running it just make terrible, self-serving decisions?
You've hit on the most volatile element of all, the human element. Even the most impenetrable competitive advantage will eventually crumble if the people steering the ship are incompetent or, prioritizing their own wealth over the health of the business.
There's a specific term in the research for this vulnerability, agency risk. And the best analogy I can think of to visualize this is hiring a house sitter.
Ooh, that's a good one.
Right,
Yeah.
because you own the house. You are the shareholder. But they are the ones actually living in it. They are the management. Do they treat the furniture with the same care you do? Do they fix the leaking roof? Or do they just ignore it because their lease is up in a month anyway?
That leaking roof is the perfect equivalent of deferred maintenance in the corporate world. Agency risk is the very real danger that executives will pursue their own personal interests over the long-term health of the company.
Like what's an example of that?
Well, they might slash the R&D budget to artificially boost this quarter's profits, just so they can hit a metric and trigger a massive multi-million-dollar personal bonus.
Wow. So the short-term numbers look great, but they've secretly crippled the company's future.
Exactly.
So how do we actually measure the competency and intentions of the people living in the house? I mean, we can look at their educational background, sure, but that only tells you they passed a test 20 years ago.
Track record is the ultimate measuring stick. You have to look closely at their execution of the current strategy. When they provide guidance on near-term performance to the public, do they actually hit those targets?
Right.
And do they ensure timely regulatory compliance? A management team that is constantly paying fines for late compliance filings is a team that is not fully in control of their own organization.
That makes sense. The sources also heavily emphasize delegation, which seems a bit counterintuitive to me. Shouldn't a visionary CEO want their hands on everything?
No, because that creates what is known as key man risk. If every major decision is bottlenecked through one brilliant, charismatic founder, the company is incredibly fragile.
Because what happens if that founder unexpectedly resigns or falls ill?
Exactly. A truly competent management team builds robust delegation structures and succession plans that can survive their own departure.
But I mean, assessing competency is hard enough. Assessing integrity. Unless you're reading their private emails, how do you measure the true integrity of a CEO who is smiling at you on an earnings call?
Well, you cannot. Assessing integrity is almost impossible without hard evidence, and by the time you uncover the evidence of fraud, your investment is already wiped out.
So what do?
You cannot rely on judging a person's soul. Instead, you must rely on the rigid structural guardrails put in place to keep them honest.
And that brings us to the rules of the game. Corporate governance. Because we can't read their minds, we have to look at the fences built around them. Let's get into the weeds on these guardrails, because the global standards are quite specific here. Let's start with board composition.
Right. The board of directors is supposed to be the ultimate check on the CEO's power. But that only works if the board is truly independent. A standard rule of thumb globally is that if the chairman of the board is an executive of the company, like the CEO, then at least 50% of the board must be comprised of independent directors.
And if they aren't the CEO?
And if the chairman is not an executive, then 1/3 of the board must be independent.
Okay, but what does independent actually mean in practice?
It means they have no material or pecuniary relationship with the company outside of their board seat.
Yeah.
They aren't related to the founders. They aren't major suppliers. You need people in that boardroom who are not dependent on the CEO for their livelihood.
So they have the freedom to look the CEO in the eye and say no to a reckless idea.
Exactly. In fact, many global regulators are pushing this even further. Take India, for example, where the regulator, SEBI, has mandated that the top 1,000 listed companies absolutely must separate the CEO and board chairman roles.
That makes total sense. I mean, The person running the day-to-day operations shouldn't also be the person leading the oversight committee that is supposed to grade those operations.
Right. It's a massive conflict of interest.
Let's talk about auditors, because there's a specific threshold regarding auditor fees that I found really fascinating. The fees an auditor receives from one single entity shouldn't exceed 10% of their total income.
Yeah, think about the basic psychology of human nature here. If a massive, disproportionate chunk of your accounting firm's yearly revenue comes from one single corporate client, your objectivity is severely compromised.
Because you need them too much.
Right. If that client's CFO suggests a slightly creative accounting method to hide some debt, how hard are you really going to push back? The 10% rule ensures the auditor isn't financially held hostage. They can afford to walk away if they smell something illegal.
There's also a rule in many jurisdictions requiring mandatory auditor rotation every 5 years.
Yeah.
But wait, if you have an auditor who understands your complex business deeply, why force them out just when they hit their stride?
Well, if we connect this to the bigger picture, mandatory rotation acts as a built-in ticking clock. Imagine a scenario where management has been quietly concealing financial manipulation, aided by a friendly, overly compliant auditor.
Okay.
They know that in a maximum of 5 years, a brand new, highly skeptical accounting firm is going to walk in and rip through their books. That ticking clock prevents the kind of cozy, decade-long relationships that create dangerous blind spots.
Oh, wow. That makes a lot of sense. That leads me to a phrase that always sounds terrifying in financial reports: related party transactions.
Yeah.
Like when a CEO hires his brother's company to provide the corporate logistics, is that an immediate flashing red siren to sell the stock?
It's a heavy yellow flag. Related party transactions aren't inherently illegal. I mean, sometimes the brothers' logistics company genuinely is the cheapest, most efficient option in the region. But those transactions must be conducted on an arm's-length basis.
Meaning the pricing and the contract terms must be exactly what they would be if they were dealing with a total stranger.
Precisely. Furthermore, these transactions must be presented to the audit committee for intense scrutiny. This is a classic area for agency risk, where founders can slowly siphon wealth away from minority shareholders by overpaying family members for subpar services.
Yikes. Speaking of founders and major backers, often called promoters in the research, it highlights a hidden danger regarding the shares they own. It's a phrase that sends shivers down an analyst's spine: pledged shares.
Oh boy, yes.
Let's get into the mechanics of this, because it sounds incredibly risky.
It is a vital piece of the puzzle that many retail investors completely ignore. So promoters often own a huge percentage of the company. Sometimes they need massive amounts of personal cash to fund a new, unrelated venture, but they don't want to sell their stock and lose voting power.
So they want the cash, but want to keep control.
Right. So they go to a bank and use their millions of shares as collateral for a cash loan. They pledge their shares.
Okay, so they get the cash, the bank holds the shares as security. That sounds pretty standard until the stock price of the company starts to drop. Walk me through this death spiral.
Okay, so when the stock price dips, the total value of the bank's collateral shrinks. Suddenly, the bank feels exposed. They issue what's called a margin call, demanding the promoter provide more cash or pledge more shares immediately to cover the gap.
And if they can't?
If the promoter's out of cash and out of shares, the bank exercises its right to forcefully liquidate that collateral.
Meaning the bank just dumps massive blocks of the promoter's stock onto the open market indiscriminately.
Yes. And dumping that much stock suddenly floods the market with supply, which crashes the share price even further, which triggers even more margin calls. It creates this vicious, self-fulfilling downward spiral.
Wow.
A minor dip in the business fundamentals can turn into a catastrophic collapse in the share price simply because the promoters had high pledged shares. As an analyst, tracking the percentage of pledged shares is mandatory.
Even with all these guardrails in place, management can still develop severe blind spots. So how do we test their grip on reality? Our sources mention that if management claims that nothing could go wrong in their business model, analysts immediately classify them as people who don't know that they don't know.
Yeah, it's the ultimate red flag of corporate arrogance. A truly elite management team is deeply, almost obsessively aware of their own vulnerabilities. If they stand up at an investor conference and claim invincibility, they are utterly unprepared for the inevitable shock that is coming.
Here's where it gets really interesting. One of the ways to track how management handles reality is by looking at something totally counterintuitive. The research suggests that equity investors, people buying stock, should use credit ratings as an analysis tool.
Yes.
Wait, Why on earth should I care about reports written specifically for bondholders and debt buyers?
For two highly pragmatic reasons.
Mm-hmm.
First, the brutal reality of the corporate capital structure. Lenders and debt holders always get paid before shareholders. Always.
Wait, really?
Always.
Always.
If a company goes bankrupt, the bondholders get whatever cash is left after liquidating the assets, and the equity shareholders usually get zero. If a credit rating agency downgrades a company's debt, the financial risk of default rises. The pie shrinks, and as a shareholder, you are dead last in line for a slice.
Okay, well, that makes the stakes very clear. And the second reason?
The historical evolution of the rating itself. Credit rating agencies publish detailed rationales highlighting their specific concerns. If you pull the credit reports from 3 years ago, you can see exactly what the agency warned management about. Maybe it was too much short-term debt or over-reliance on one supplier.
And then you compare it to today.
Exactly. You read today's report. Did management address those concerns? Did they fix the leverage issues? Or did they ignore the warnings entirely? Tracking credit ratings over time provides a secret window into the responsiveness and ego of the management team.
That is a brilliant way to use a debt tool for an equity decision. Which brings us to the final framework for unearthing hidden risks. ESG, environment, social, and corporate governance. Now, for a long time, ESG was viewed as a niche metric for, impact investors, people who wanted their portfolios to align with their personal morals.
That perception is completely outdated now. Today, the world's sharpest financial minds view ESG as a hardcore commercial valuation tool. It is no longer just about ethics. It's about minimizing catastrophic operational disruptions.
Right. We are seeing major global markets adopt this heavily. Returning to India as a prime example of global trends, the top 1,000 listed companies are now mandated to file a BRSR, a business responsibility and sustainability report. What kind of data is actually in a report like that?
It forces companies to quantify things that used to be invisible. They have to report on their total energy consumption, their waste management practices, their employee turnover rates, and their board diversity.
Things that actually hit the bottom line eventually.
Exactly. The market has realized that ignoring environmental or social factors carries a massive financial penalty. If a company is secretly dumping toxic waste, they aren't just bad citizens, they are one regulatory stroke away from being fined into oblivion or completely shut down. That is a pure commercial risk.
Right, or if they treat their workers terribly.
If they treat their labor force poorly, they face imminent strikes, high attrition costs, and a damaged consumer brand.
So strong ESG practices actually lower a company's cost of capital. Lenders and major institutional investors view the transparent company as fundamentally less risky, less likely to trigger a massive scandal or regulatory crackdown. Because the risk is lower, they're willing to provide funding at much better interest rates.
And that lower cost of capital flows directly to the bottom line. It provides long-term investors with visibility into how sustainable the business model truly is, not just for the next quarter, but for the next 20 years.
Let's recap the journey we've taken through today's sources. We started with the absolute foundation, demanding a business model you can actually comprehend, and seeking out the defensive shield of pricing power. We moved to the competitive edge, using a reverse SWOT analysis to see if external threats will expose hidden internal weaknesses.
Yeah, looking at the threats first.
We navigated the very human flaws of agency risk, learning that execution matters far more than a charismatic vision. And finally, we looked at the structural guardrails. Independent boards, the ticking clock of auditor rotation, the hidden dangers of pledged shares, and how ESG and credit ratings illuminate the blind spots management tries so desperately to ignore.
It fundamentally changes the way you look at a balance sheet. It forces you to look past the marketing, ignore the executive charisma, and examine the structural bones of the organization.
So we'll leave you with this final provocative thought. Think about the company you work for right now. You know the internal politics, you know the culture, you know the management team.
You know where the bodies are buried.
Right. If you were an outside analyst looking in, armed with the tools we discussed today, what hidden agency risks or unacknowledged external threats would you spot that the general public doesn't see? Who are the house sitters in your organization, and are they actually taking care of the furniture, or are they just ignoring a leaking roof?
It's a question that reframes everything.
It really does. It gives you the power to look at that entire industry, spot the subtle flaws in the bad companies, and confidently deploy your capital into the winners. Thank you for joining us on this deep dive into the mechanics of company analysis. We love exploring these frameworks with you, and we appreciate your dedication to staying sharp, staying curious, and being well-informed without getting overwhelmed by the noise. Keep analyzing those guardrails, and we'll catch you on the next deep dive.